Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite, we have Kevin McPartland. He's the Managing Director of Market Structure and Technology over at Greenwich Associates. And we're going to focus on the U.S. Treasury market structure, as well as some data and analysis behind that. Kevin, it's great to have you back.
Thanks for having me.
In studio with me, and Treasury volume continues to be elevated.
It certainly does. I think the volatility in the market, there's a lot more uncertainty after years and years of very consistent policy out of Washington. Now there's a bit more uncertainty as to where the Fed will go, where rates will go, which is driving up activity in the market. We saw big spikes of volatility in the fourth quarter that really drove up volumes. We had a $700 billion day in December, which was fantastic, and yeah, we're still averaging about $600 billion in January. So even though the equity markets have rallied, there's still been quite a bit of activity in U.S. Treasuries.
All right, and how about electronification? That seems to be the trend as well.
Yeah, well, that's certainly helping the market along. You're pushing almost 70% of volume is traded electronically in U.S. Treasuries today, which is great. It provides a lot more price transparency. It's a lot more access for really everybody in the market, whether you're a dealer, institutional investor, or even on the retail side. The dealer to client space, so when we have buy side trading with the banks, that's growing as well. That's a little bit less, say 40% of volume or so. But there's still a big relationship component that's important there. And I think the next stages will be using technology to grow those relationships while still maintaining them over the next couple of years.
All right, and it's interesting because dealers actually cut slightly their Treasury holdings for January.
Yeah, so it's been a pretty steady rise over the last quarter or so. The dealers have been sort of holding more and more Treasuries. It's not exactly clear why that is. There's been some selling from China. There could be positioning going on, as we said, as the Fed starts to change policy. It did look like it pared back, to your point, it pared back a little bit in January, although still pretty elevated if you look back even a year or two. They're holding quite a bit more than they have for quite some time now.
All right, let's spend some time on Sofer. We're seeing volumes climb there, but before we can get into that, what exactly is Sofer? How is it changing the market?
Sure. So as most of the viewers probably know, LIBOR is being phased out, right? A long-used benchmark interest rate being phased out now. So Sofer is one of the new sort of LIBOR replacements that are being put forward. It's calculated by the New York Fed. The big difference is rather than the dealers contributing prices that then get turned into a benchmark, it uses actual data, observable data to calculate that rate every day. And hopefully the expectation is that will, especially in the US, that will replace LIBOR.
Well, because there were some issues with LIBOR, do they expect that Sofer could be manipulated in any way?
Well, they don't think so, and that's the reason why rather than going to a sort of a consensus benchmark, they're going to move to a data-driven benchmark. So you're pulling in thousands and thousands and thousands of executed trades on a given day to use to then calculate the rate. So it's not based on what people are saying the rate is, it's based on the rate as to how people trade it, right?
All right, now you're seeing the volumes climb as people start to adopt Sofer, or is it kind of like everything with fixed income, volume begets volume?
Yeah, I mean, there's certainly some of that. So what we're talking about specifically here is futures based on Sofer, right? So this would be, obviously there's always some speculation, but in the long run, it's going to be more about using those instruments to hedge against positions that are tied to Sofer or related to that sort of that benchmark rate. So futures volumes have been climbing, cleared swaps volumes just getting started, but also starting to climb, which does show sort of increased use of that benchmark. And again, the total shutdown of LIBOR is still about 2 years away, but there's a lot of work to be done for everybody involved: pensions, endowments, asset managers, hedge funds, the banks. Everybody has a lot of work to do to make sure they're ready, and getting used to trading these new products is part of that.
All right, so let's wrap up fundamentally. Why do you look at this kind of data monthly? Does that help you with your macro work?
Yeah, well, right. So we want to understand sort of how the markets are moving. There are economists and traders that track, the prices in the yield curve. That's not really sort of where we're focused on. We're focused on more broadly how the market functions, how it's changing, how regulations and technology are impacting that. So by examining the data, the use of different electronic trading platforms and volumes over time, it can tell us a lot, especially if you look at it sort of over time. It can tell you a lot about how things have evolved, but also how they are likely to evolve going forward.
All right, Kevin, thank you so much, as always, for joining us at MarketSite. And thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.